What's up? What's up, everybody? Welcome aboard to Trading with Bubba. It is Tuesday. It is October the 17th. And, well, I can tell you this. The markets look like they're ready to collapse, but they're trying to push higher here. It's kind of a little bit of an oxymoron, but at the end of the day, they look pretty bad, and they look pretty weak. And as we take a peek at what's going on, the Qs reached resistance on last Thursday, Friday. Are coming down. I would assume they'll come down to the 360 level. We'll see what happens from there. But I think that when you look at the overall picture, they look like they want to go and work their way lower. I think the spiders look the same. Okay, you reached resistance, you're failing. Okay, and again, you've got the same pattern. We're watching this consistency of lower highs and lower lows. I think that indicates that we're probably headed south for the winter. Again, there's no prediction. It's just, again, you're really just trying to play the patterns that you're watching and the time frame that you're watching. And remember, we like to look at these shorter term charts. They don't look as bad as the longer term. But again, remember that when you talk about universal price, all charts are the same. All patterns repeat themselves. And the shortest time frame is always the leader. So we're seeing a little bit of a pop here in the short run, but to me, when I look at the longer, it looks like this should fail, and it would not surprise me to see it fail at all. There's been very little trading activity on a short-term basis. We haven't had enough action. The volume has been really down, across the board, from the spiders to the IWM. Again, you're getting a little bit of a pop in IWM. You probably get a great opportunity at about 175 to sell. Now, again, basically, when I'm looking to sell or get short, I don't jump in with a full position right away. I would be looking to, potentially sell call spreads right now, and then look to add to that later if it's confirmed that the pattern is going to trade and trend lower. I think that you have to remember that the overall market conditions right now are extremely slow. Okay, the overall conditions. There is not a lot of energy to this market. You're not seeing a lot of these big volume bursts, even on a daily, to want to get overly excited about. And I think that's one of the important things that we have to remember as traders and investors is that we need to have the markets in our favor. We need to put the information in our favor. And, if it's not, then it's sometimes better to watch. There's an old saying, it's always better to wish you were in a trade than to wish you were not. And, as we go back and look, and again, just looking at, pretty much across the board, and let's go to the futures market for a minute, because those are more active trade, more over the time. The S&P, just like these spiders, right at resistance, looks pretty bad. The NASDAQ broke from resistance and is coming lower again. I think the key you want to watch is around the 15,200 level in the NASDAQ itself for a clue of what it's going to do from here. We're kind of in that space where we chop back and forth, and those who you like pivot point, this is like a pivot point. Okay. The Russell, which made a head and shoulders, left shoulder, head, right shoulder, neckline broke. Again, this looks like it's a great spot to take a stab at the short side. Now, one of the things I do personally is I would wait now and I'd say, okay, so I know that I want to be a seller of the of the Russell, okay, or the IWM, but we use the Russell for now. What I would be doing is I'd take this down, and depending on the long time frame, since I'm using it daily, I'm going to use, let's say, a 20-minute to go with this, right? So based on this, I'd be selling this now, okay? I have the information that we were coming down just by these last 40 minutes prior. It showed me a couple of red bars. So basically, this looks to me like it's a double top. And of course, if you've heard the term before or you've traded it before, you know that double tops work the best in markets that are trending lower, and double bottoms work the best in markets that are trending higher. Well, this is certainly trending lower, and this would certainly be an opportunity to take advantage of that. Now, again, is it going to work? I don't know. But I will tell you that what you have to make sure that you do is you have to understand whatever you put on a trade, you better know where the exit of that trade is going to be. Okay. One of the reasons we use spreads to start with to build a position is because I don't have to worry about an exit point. The spread itself determines the amount of risk that I have to take. Remember, this business is a risk business. It is not, it's about managing that risk and capitalizing on opportunity without exposing your money. So I think when you look at the overall patterns, and again, whichever side of the market you're going to be on, you still have to have an understanding of where you're getting out. Okay. And I'm assuming that if you're watching this, you're probably more of a trader than an investor, although we're probably all investors. But I think as a trader, you must make sure that you take your exit points where they are. You cannot make exceptions to those movements. You have to say, I'm willing to risk X, okay, which is a percentage of my portfolio. And I'm gonna, if it hits X, I'm out. Okay. And of course you can adjust, but when I use spreads, I don't have to worry about X. I don't have to worry about the exit because the exit is built into the trade. In fact, most of the options trades that I personally make have built-in stops to begin with. So I don't have to get involved and deal with where my exit is, and I can let it trade knowing the exposure or the risk that I took off the gun. Okay. And I think that's something that is important for you to understand is if you can assign the risk that you can afford to take and that you're willing to take, then you don't have to come down to a decision later, depending on what the markets are doing, because the position itself would give you that. So for example, let me bring you back over here for a minute. So if I'm looking at an options chain, and let's just say that I wanted to make a short position in IWM. Okay. So IWM, if I were going to sell call spreads, I'd be looking at the weeklies because I want the time to click as fast as I can. Because with the trading at 175, I would probably sell the 175, sell a vertical. So if I sold the 175, 177, okay, I'm going to collect 85 cents or $85 for every one contract I put on. My risk is how much? It's $1.15. There's a $2 spread risk minus the 85 cents I collected, and I'm protected up to 175.85. So the stock could run another $1 before I'd be in jeopardy. I would look at this as an opportunity based on being at a double top, based on where we sit and where we stand. And again, it would be, now if I decided that I wanted to take something a little bit more aggressive to the short side, I would probably go out to the following week and I might look at using a synthetic type of stock, okay, which would be, I would be selling a call spread and buying a put. So let me just set this up real quick. Okay. So right here, okay, I am buying the 175 put for the 27th of October. I am selling the 175, 180 call spread. That is a cost of a 42-cent debit. Okay, so what is my risk on this trade? My risk is $542 for every one contract. Okay, it's the $5 spread risk plus the 42-cent debit. Okay, so now I got a 40% risk. Now, the interesting thing about this is if I look at the 175 put for that same period, I'd have to pay $2.36 for that right now. I'm really synthetically buying that put for 43 cents. So if I buy that put for, is it better to buy it at 236 or 43? Now, obviously, there ain't nothing for nothing. Okay. I'm actually taking an extra $300 worth of risk to put that trade on at 43 cents instead of 236. But if I'm right, I'm going to get paid. And if I'm wrong, I can't exit early. Okay, I can use the 236 as a potential exit point, okay, of the risk I was willing to take. But now I've got myself set up and I've now erased the premium risk, the time risk, because now I'm just basically short the stock through a synthetic model with a maximum risk of $5. My potential profit remains unlimited. So what's wrong with a trade like that? And again, these are things, the combinations that you can use in derivative products or in options, okay, is you can create whatever you want, okay? And the creation means that you, before you can create, you must understand how to establish risk on the trade that you're putting on. Right? Like I never sell naked options. Now, I know many of you sell puts naked, you want to own the stock. Well, I think that's ridiculous. But again, that's just an opinion. Right? But I think there's a much better way to do that same trade. So why would I want to open myself up to that amount of risk and that amount of margin when I don't have to? So when I can create whatever I want to create, but you have to be able to assign your risk exposure to any trade that you put on, because if you can't establish the risk, then you don't know the trade you're putting on. You don't understand it, and that's the most important thing in the world of trading is understanding the type of trade you're putting on. Why are you putting it on? What's the purpose behind it? Okay, and that is a very big thing to your trading success, is understanding the risk without a risk graph, okay? Because risk graphs are horseshit. But again, I'm not gonna get into anybody, but they do not do cross time periods, okay? Cross months. So what good is it? But if you cannot figure out the risk yourself on a trade, and you can't look at a trade and say, what I'm doing, that you don't understand the market. You should not be trading in the market until you can understand those things. Right? The tools that are out there don't teach you how to read the charts properly. They don't teach you how to put the proper trade on. You've got to learn to put what trades you want to put on and how to get to the trade you want. So again, this trade here is the same as buying the 175 put for the 27th of October. Now I could make this same trade if I wanted. I could do this for this Friday if I wanted to do it. Okay. So what would I be doing then? Would it be the same advantage? Okay. Again, there's a lot of flexibility that I have in the market. I'm going to bring you back here in a second. Okay. All right. So if I change this all to the 20th, which is Friday, I can put that put on for $0. And what is the 175 put right now? Okay, it's $1.50 or $1.46. So I can put this on for $0. I still have the same $5 risk, but I have no time decay. If I'm right, I'm making dollar for dollar right from the start of the trade. I don't have to overcome any premium risk. Okay. Now, again, there's another combination you could use, and I could certainly sell the call spread for this Friday, and I could buy the extra put for next Friday, which was the reason I would do that, okay, is it would give me the opportunity to sell the call spreads once again for next week. So when these expire, I could sell them again for the following week. Okay. Now this trade cost me 71 cents. So what is my risk? It's the $5 spread risk plus the debit. So it's $570, but I'm really creating ownership of the 175 put here, which is 220. So once again, look in the mirror and ask yourself the question, is it better to pay 220 with a $220 risk, or is it better to pay 70 cents or 46 cents or nothing and have $5 risk or $500 worth of risk? Okay. Is it better to step up and pay that premium, which then puts you in subject to time decay and everything else? Those are the questions that you need to ask yourself when you're trading, because maybe you're trading too big, so it doesn't make sense. If you're trying to trade a 10 lot, okay, so you're going to risk 2,000 or 2,300 versus 5,000, okay, maybe you should risk 2,500 and do half the size of the normal trade, because the way that I'm showing you is far better than just buying the put. Okay, in the options, you want to buy naked as often as you want to sell naked. Never. Okay, you want to be able to create out of the derivatives market a position that puts you in a position to make the most amount of money. Okay, and because you can manage that trade, it should be the most amount of money with the least amount of risk. And if you're reading the chart correctly and not using your opinion, because opinions, we all have them, and none of them are ever right, including mine. Okay, I have an opinion on the market, but that doesn't mean I'm going to trade that opinion. I am going to sit back and look at the chart as we did, and if we go back and look once again and see the action that we're seeing, and of course, here we see this still holding right in here at resistance. Okay, we see the spiders right at resistance. We see the Qs right at resistance, a little bit below it, and the diamonds are probably somewhere in the middle. Okay. Okay, and there they are, right at resistance. So again, why would I not want to take advantage of using the chart and the technical read that I have, knowing that the price action in the market is dictated by this very action? Okay, that's what you want to always remember, is the market action, the price action is like a map. This is leaving a footprint for you to kind of give you the best idea. Now, again, obviously, we know the maps are sometimes wrong. Sometimes we get on the wrong side of the map. Listen, that is where the defensive mechanism of what we do comes into play. Okay, that's why we have to always understand the defensive side of the trade as well as the offensive side of the trade. And again, a lot of these things go down to your approach to putting on the trade. How are you deciding to put the trade on? If you're deciding by watching the idiots on the news channels, you're making a big mistake. I mean, if you look at Goldman Sachs, they had glowing earnings this morning. Okay. And of course, what is Goldman Sachs doing? Well, let's see here. It's getting clobbered. Okay. Not down as much as it was, but it had terrific earnings. But if we go back to just what we've been talking about today, it was at resistance anyways. So if you learn to understand that markets have priced in much of the action to begin with, well, then it'll make a lot more sense for you to follow this footprint that we're looking at. It doesn't matter what we're looking at, Goldman Sachs, you can look at anything you want. Apple, okay? Look at the footprint of Apple, failed at resistance. It's in a downtrend, okay? I mean, that's as clear as that's as clear as a bell, as they say, okay? Now, again, it doesn't mean that we're going down forever, but right now, the path of least resistance in Apple is down. The path of least resistance in Meta is what? Is up. Okay. There. Again, clear as can be, still in consolidation, but the path is flat to higher. Okay. And again, you can look at any stock you want. Okay. Or Nugget. Okay. Now, if you remember last week, I said that you were going to take a shot in gold, and I wasn't recommending for you to take a shot. Listen, I do some shot taking on my own, but I don't want people to get involved who can't afford to do so or take that risk. But really high probability that gold was going to make a pop, and there you see it. There is gold making a pop, and I think that if you start to recognize that, okay, and you put yourself, again, this is all about being in the best position for yourself. Okay, that's what the business is about. It's always about, am I in the best position for myself? Okay, because other than that, there's nothing else you can do. So you have to keep yourself in a positive position so you can see that this is breaking out. So the next logical spot that we should see some resistance here would be like $33. Okay. But in the meantime, we were talking about buying it down when it was 25 or 26. All right. And it doesn't matter. Every stock is the same. It doesn't really matter. Tesla is straight sideways. Okay. So do I want to trade Tesla? What do I want to do here? Well, what would I want to do? It's in the middle of nowhere. Okay. And I'm not a big iron condor fan, but that would be the kind of trade I might look at here. But more than likely, okay, in my world of trading, okay, I would pass, okay, on that kind of trade, because I don't want to be guessing or hoping that it goes and stays sideways. I want it to be what I think it's going to be, not trying to guess or hope to get lucky. Okay. and pick one side or the other. I think that's a common mistake that too many make, that we're wishing and hoping for it to stay in this range. What do I give a shit? I don't want it in this range. Let it move out, and then I'll trade it. If you're in a hurry to trade, it means you're in a hurry to maybe lose money. Okay, you got to defend your capital as best you can, because that's what the whole business comes down to. It's about we're in a capital defense fund here. Okay, you got to make sure that you have inventory at all times. You got to make sure that you are always putting yourself in the best opportunity, the best position to be successful. If you continue to put yourself in jeopardy by taking ridiculous shots and buying things or selling things that, just because you heard somebody on the news or some ridiculous opinion, you're making a mistake. Okay. Again, the charts are as clear as they get. Okay. And again, you're not going to be right every single time. But if you're always putting yourself in a position, okay, of probability, here, zoom. Tried to break down, false break out to the downside, but you can bet your ass $66 is a great resistance level to sell. Okay, now you don't have to sell it there, but again, don't force yourself to make trades that are not good trades. If it's Zoom is a stock that you trade and it reaches a resistance level, clearly the stock is broken to the downside. Okay. Clearly, this is just a little bit of a dead cat bounce in a market that appears to want to go lower. And again, it doesn't, like I said, it doesn't matter. Coin's had a little bit of a bounce, but where is coin? It's in the middle of nowhere. It keeps churning between 70 and 80. So unless I can pick the absolute top and the absolute bottom to make money, why should I bother trading it? The key to making money in the business overall, okay, is to be able to ride the long-term trend with any position, whether it be up or whether it be down. Here, I have no idea which way it's going to go. Okay, this is a straight sideways market and has been basically for 6 to 8 weeks. So why would I want to get involved here versus Amazon? Very similar. Okay, working its way lower, but still it's kind of mixed up. And you have to be able to confidently look at a chart and say, this is a trade that makes sense. This is a trade that the price action matches what my trade should be. And this is where I think I can make the most amount of money. And then this is the trade setup that I'm going to use. And you can never, ever mix in investing and trading. They are two completely separate vehicles. And if you're not using a trading plan, that's your first big mistake, because you have to isolate what you're doing, whether it be a trade or whether it be an investment, which means, and you're like in my investments, I already have a hedge model. My stuff is all hedged based on a program that we have that I wrote, that when somebody wrote for me, that is automated. Okay. It buys and sells and protects my overall core position. So I don't even look at that. But when I'm trading, I have to establish my risk. I have to establish what is the best for me and what is the best trade to put on. And sometimes the best trade is no trade. Okay. That is something, and especially now as we're entering the earnings world, the earnings season, if you're buying options right now, and like for next week in many of these equities, you're getting ripped off. Okay. If you remember the one thing I'm going to teach you now, okay, options are always fairly priced, except when they're expensive. They're never cheap. Okay. They're either fairly priced or they're expensive, because if you remember that there's a market maker on the other side of every trade, okay, then you'll recognize that they're fairly priced. But they do get expensive when you can see there's a dramatic amount of buying in this week's Netflix options. Look at the volatility, 110%. Okay. So what is that telling you? It's telling you that you have buyers of puts and calls. You have people looking for a move that is outside of the expectations of $30. Okay. Netflix should move. I think the earnings are tonight, I believe. Yeah, tonight. No, wait. what's the 17th? Tomorrow. So tomorrow. Netflix should move $30 up or down tomorrow. Okay. That's what the market is pricing in. Anything less will be a disappointment, and that premium will collapse. Okay. You cannot be buying options in tomorrow's or in this week in a stock like Netflix. You'll get crushed. Okay? You have to, if you're going to do something with Netflix this week, you got to be a seller of the front or the near and a buyer out in the back, because you'll see. Let me bring this back for you real quick. You will see how the volatility changes. 109, 69, 57, then it gets back down to 48 in November, which is where it belongs. Okay, that's where the average trades at. Okay, again, historical volatility will not help you, except it will give you a guide of where it could be and where it should be. Okay, and that is what you need to understand. So the proper trade in a Netflix, for example, if you're going to use one, is to sell premium in the front or in the for this week for the 20th, but you have to buy some behind it. Okay, because you don't want to be stuck naked in case it does make such a big move. But I urge you to watch the earnings tomorrow after the close, okay, and then look at the options on Thursday morning when the market opens. And I will guarantee you that if Netflix stays somewhere between it's 357, I would say somewhere between 370 and 340, every one of these options will be down on both sides. Puts and calls will all collapse, okay? Because they're so overly filled with error. The volatility has been pumped up way too high that will not allow this to go. So if it does not move $30 one way or the other, and even at 30, most of the options are going to lose money, okay? For this to make money, this stock's got to move $40, $45 tomorrow. So keep that in mind when you start chasing these earnings trades and chasing these earnings, because at the end of the day, more often than not, you're going to get clocked because of the collapse in premium. If you had to place a trade for Netflix for tomorrow, what would I do? Well, I've already got a trade on, but I might look at potentially a straight calendar, a double calendar. But I'd have to really look at it. I don't have enough time to go through it now, but I would definitely have to include, I'd have to know the size of your account, what you're trying to do. Okay. But I would certainly look at a potential double calendar around $30 up and $30 down, knowing that I would be able to sell that inside calendar every week for the next, 6 or 7 weeks, and hope that it stays inside the range there. But I don't really have one I can give you right now, because I don't want to give you a bad trade trying to force one right today. Okay. Certainly, and when we come back over the next couple of shows, I'll give you a couple of trades on a couple of things that I either have or will do. But for today, that'll do it. And just be careful out there. It is not that active. So we'll see you back here on Thursday. Have a great day, everybody, and we'll see you later.